Right, good morning to our wonderful audience and welcome back to Boutiques on Wednesday. It's always great to have you all joining us. If you look at markets and if you look at what's happening and some of the discussions we've had over the past 3 or 4 weeks, the US is still running hot with slowing growth and excessive debt and a government that's not working yet. It appears as if the world has lost faith in US, seeking refuge in gold. But then what about US bonds? Can this be a viable option to hedge some of your bets? And speaking of bonds, if you look at SA and towards SA bonds, yes, we know by now returns have been very attractive over the past 18 months. And we've seen some very bullish arguments favoring SA bonds the past few weeks. But were there not too much good news front-loaded in prices that perhaps requires us to be a bit more cautious on SA bonds? Here to share their expert views, we are joined by two top fund managers this morning, a fixed income manager, JP Duplessis at Methodical, and Paul Fischer, Chief Investment Officer at New Road Capital. Good morning, JP and Paul. I hope you both keeping well. How are you doing?
Morning.
Hi, Eugene. Yes, very, very well. Thank you. Weather's improving in Pretoria after a couple of rainy days, so things are looking good.
Yeah, always looking good. And again, thank you very much for your time this morning. I saw your topics as well. It's going to be very insightful and to see how things play out. Paul, I see you've got your slides up and ready. And you're welcome to start. To our audiences very quickly, you know how it works by now. Paul's going to do his presentation, followed by JP, and then we'll take a couple of questions afterwards. So you're more than welcome to post your questions in the Q&A bubble. Thank you very much.
Perfect. Thank you, Eugene, and thank you everyone for joining. Always good to be able to chat to everyone. We know it's quite busy during the end of the year as well, so thanks for taking the time. So really today we're gonna talk a little bit more about the US. Obviously, that's the hot topic at the moment. Just also and also actually a market that we still really like, so we think it's quite applicable and apt to talk about it. Before we get into the preso, just a quick just showing off of the fund, our Enhanced Opportunities Fund, which is our flagship. The fund at the moment is just under 3 years old. It turns 3 in February. Just to give you a return, so over the last year, it's had an outperformance to benchmark of about 4%. And then since inception, that also translates to around a 4% per year outperformance. Cumulative outperformance over the 2 years and 8 months we've been running the fund sitting at 12.3%. So we're quite happy with the performance, and it's really been a good fund for us. The strategy is working really well for us. So just wanted to share that with you before we get into the topic. But as Eugene mentioned, there's this talk of debasement in the US. That's a big talking point at the moment. Everyone's talking about gold and what's going on with that. And what you've seen over the last few years is you've seen this gold price just have an absolute rocket. So this debasement trade has really been all the rage. And you've seen this happening at the same time you've seen the US dollar and US treasuries kind of debasing. So that's what the debasement trade really is. And is it a loss of faith in the US and what's going on here? Now, our view is slightly different. We don't think it's a secular kind of protracted long run loss of faith in the US. If you look who's been predominantly driving this, a lot of central banks, but over the last few years, Russia and China massively buying gold and selling their US treasuries in terms of their foreign reserves. So that's a big, if you start breaking down the numbers, you start to see who the actual players are. They've been huge buyers of gold in that space. Now we still think that this could work going forward for a while, but we're more interested in what's going on with this debasement over here. What are the reasons that you've had this debasement? So what are the kind of narratives that are driving this? It's really the stack. We don't think it's protracted. We don't think it's a sort of secular trend. We think it's more cyclical. And really the reasons are everyone is projecting slower growth out of the US, okay, and higher inflation. And obviously those two together called stagflation. So really we call it the stagflation trade rather than the debasement trade. And we think it's a cyclical kind of trade out of the US, but we don't think it's long-term. And what we wanted to kind of show today is looking through the noise and looking through the narrative, what's actually happening in reality. So, it's the topic of our slide is reality versus expectation. If you look at the expectation, this is what's expected. It's very well known that I'm all these sort of multinational organizations, a lot of people in the news are expecting slowing growth out of the US and higher inflation. Now, if we actually delve into the numbers, so expectations, this is just IMF kind of expected growth going forward from here. They're expecting the US to grow at about 1.8% a year, slightly declining over time, 2 to 1.8% a year, and come off. All right, so that's their kind of up till 2030 view, so 2025 to 2030 view. So below 2% growth. If you actually look what's happening, the last Q2 GDP growth in the US is at 3.8%. Quite a significant increase. If you look annualized, it's still sitting at 2. But if you look further out on this chart, and what we're predicting is, if you look at Q3 numbers didn't come out because of the federal government shutdown. There's a lot of numbers that everyone's waiting for that haven't come out yet, but you can kind of get a sense of what's going on. And the expectations for when that number does print in Q3 is we're looking at anywhere between a 3.5% to 4% growth on top of this 3.8% growth. And we're actually thinking you're going to see an opening up of that US economy, and that's predominantly driven by supply side, a benefit to the supply side as a result of the legislation, the One Big Beautiful Bill Act, or the One Big Beautiful Bill now that's been passed in the US. That's going to really open up, and you're seeing it in the numbers already, and you're seeing that. So you've seen a bit of a slowdown, with the tariff talks. That was Q1. So you saw a bit of slowdown with the tariff talks, but coming out of that, you're definitely seeing this increase in growth, and we're thinking that you're gonna see that going forward. So we're thinking the reality in terms of GDP growth in the US is quite a lot bigger than what people are, or what the consensus is. Consensus expecting slowing growth. We're expecting increasing growth from here. And those are the numbers that we are looking at very, very, very closely when they come out. The second one I mentioned was inflation. So, the market consensus is for raised inflation. Now you can see this is the University of Michigan. It's a big sort of, it's one of the sort of larger inflation predictors. People monitor it quite closely. And you can see that inflation expectation going into 2025 after the tariffs was fairly high. And you can see that that's already dropped off quite a lot. So it didn't materialize. And sort of picking up, it's still sitting at about a 4.8% on expected inflation coming out. Okay, expectation, reality, inflation is sitting at 2.9% at the moment. Okay, and it's been fairly flat for a long time. Okay, if you look at pre-COVID, so where Trump was also in charge, there were tariffs there, not as big, admittedly, as the tariffs now, but no inflation and still no inflation. Now, if you look at shelter. You take out shelter, so the headline inflation number is 2.9%. You got food and energy that raised it to about 3.1 at the moment. But if you take out shelter, it's sitting at about 2.5%. Shelter is actually still the biggest core driver of inflation in the US at the moment. If we break down those inflation numbers, just the last numbers that came out, you can see that a large significant of the inflation, that 2.9% number, is actually owner's equivalent rent, which is not even a real inflation number. It's more of it's like a poll that they ask, owners what they would increase their rentals for. And that's generally a lag to inflation. And that generally comes down. It actually kind of follows inflation. So if you have a peak of sort of raised inflation, you see this owner's equivalent rent sort of coming down and then dropping. And you can see that in these numbers. So if you look at the orange is the inflation excluding shelter. So if you see inflation excluding shelter, for a long time, it's been more or less 2%, which is at the goal. So that dotted line is the 2% inflation target. You could argue how arbitrary or meaningful that target is. Should it be 2? Should it be 3? It's academic. But anyway, it's sitting at about the 2% number right now. If you look at the shelter, so if you take shelter inflation, it's that dark black line. You can see that shelter number continues to come down. And really, you can see it's been lagging this sort of increased inflation here post-COVID. That post-COVID kind of boom in inflation or run up in inflation, that shelter line has been tracking that, and it's starting to drop down and sort of meet this inflation number lower down. But really, shelter is what's still keeping inflation more elevated, we believe. And you can see ex-shelter sitting at the 2%. The most important chart or line on this chart is actually this blue line. All right, and that's really. We are monetarists at heart. Milton Friedman, famous statement, he said, inflation is always and everywhere a monetary phenomenon. And we believe that you're not going to see long-run inflation coming through because you're not seeing money growth. And then this blue line is money growth, okay? M2 money supply, all right? So the growth rate long-term before COVID, so you could see what happened during COVID, the fiscal and monetary stimulus. It was fiscal stimulus indirectly monetized by the Fed, causing a huge sort of growth in money supply. That came off quite quickly, but you can see how inflation immediately followed that growth in money supply. You can see how you had the spike in money supply, you had a spike in inflation. A lot of people still ask why you didn't have inflation post the GFC, because there was also quantitative easing during the GFC. It's because that quantitative easing didn't result in huge money supply growth. You can see that money supply growth was still kind of at the long run base case of around 5-6%. And that's why we didn't see inflation after the GFC, but why we did see inflation after COVID. Very, very, very important. The mechanisms, the mechanics were slightly different in how that money entered into the economy. Very important to note. So QE is not all equal all the time. And you can see money growth at the moment sitting actually at below long run kind of money growth where it should be. So we follow this number very closely. And that's why our view is that you're not going to see sustained inflation from here. People have kept calling the inflation numbers coming out. Is it going to be bigger, higher and higher and higher? And we've been saying for a long time, you're not going to see, you're going to see some volatility for sure. You might see some steps here and there, but we just don't see long run sustained inflation. And to the extent that you've already seen the Fed cut once this year, so they paused their cutting cycle, but they've already cut once by 25 basis points recently, and we expect that to continue. You can see that obviously this is the sort of federal fund, the median of the FOMC, where they predict long run rates to be, and by 2028 they expect it to be around 3%, so about 100 basis points below where we are now. We still expect, we think that could even become more dovish actually over time, but even if you just take the consensus right now, we're definitely still expecting cuts. We're not expecting raises. So you've got a lot. So ultimately, if you look at the actual numbers, if you look at the empirical data and you stop listening to the narratives, the empirical data is showing no inflation. And still, there's actually quite a few deflationary effects in the market. Monetary supply is not inflationary at all. And then high growth. You're actually seeing an opening up of growth in the US. And this is very important. People need to realize. Look at the numbers and stop listening to the talking heads on the TV screen. The numbers are looking very positive, and it's a supply side. The beautiful thing about a supply side bump to GDP growth is that generally it's not inflationary. Inflation usually comes from a demand-driven increase in the GDP, but if you've got supply side, that tends to feed into obviously demand, and that's actually quite a healthy, non-kind of inflationary kind of growth regime that you can get into. So we think actually looking pretty good in the US right now. You've got increasing earnings, you've got no inflation, and you've got increasing growth. Obviously, the concern is that everyone talks about, well, what about the debt? What about the debt? And we talked about treasuries, why we like to buy treasuries. So treasuries looking very attractive. You can see that blue line is the US yield curve a year ago, and the orange line is where it is now. And it's actually steepened quite a bit. So even though the Fed has dropped rates in the short term, you see the long term pushing out a little bit. Not extremely high, but you can see that curve is steepened. And people are worried about the debt. Okay, so US $37 trillion worth of debt at the moment. Our view is that the only way they're going to get out of that debt is through growth. They're not going to find it from saving. They're not going to find it from cutting spending. It's going to be very, very politically difficult to do. You're already seeing it with the shutdown that we're seeing at the moment. This federal or this Senate shutdown essentially that's going on in the US right now. It's not going to come from spending cuts. I think they can get spending under control, but it's really going to come from growth. They've got to grow themselves out of this debt. And we believe that is going to happen. You're seeing it in the numbers, and that is why watching the GDP numbers is so important to us. But if these guys can grow at north of 3.5% for an extended period of time, that's how you start to grow yourself out of debt. Just on that, their deficit at the moment actually already come down slightly. It's still fairly high. It's above where they want it to be, but it's come from a 6 handle down to a 5 handle. The US in terms of tariffs at the moment, collecting about $400 billion a year in tariffs on about a 1.5 trillion deficit. So that those tariffs already kind of cutting away about a third of that deficit, and we think that will improve going forward as you see it rolling through. But just on the treasury, still looking very attractive relative to Europe, for example. We don't think Europe's in a much better fiscal situation than the US. In many ways, we think it's worse. Its debt to GDP is not as high. It's about 20% below. In terms of debt to GDP number, it's about 20% below where the US is, but it's not growing at the same rate as the US. So we actually think very attractive if you're looking to hedge. If you're looking to hedge, a lot of guys hedging with gold at the moment. We think that a lot of that in the debasement, and we think, rather buy low and start to buy treasuries that have come off a lot. You've got a very, very low US dollar, rather start to hedge there. So that's what we are doing. So we are kind of running our portfolio at the moment, we still like US equities, we still like tech. It's been doing phenomenally well for us. We don't think that's going to end anytime soon, but hedging with the treasuries. And if you look at where treasuries are and long-term treasuries and where they are pricing right now, they're about 31% down from their all-time highs. And you can see they've built up this lovely consolidation here that we just think continues. So, the debasement trade hasn't been good for treasuries, but it's just building up this nice consolidation. And we just still kind of buy, as we take profits from our equities and managing our risk in our portfolio, we're just hedging that back with these long-term treasuries. And you can see that anytime you sort of get a sort of pain point in the markets, those treasuries do tend to run. Our view is that, like I said, we don't think there's this long run protracted loss of faith in the US. We think it's more cyclical than that. We think there are, a big part of that driver out of that debasement is Russia and China. And we just think it's a cyclical trade, not a long run trade. We think that this kind of pattern will continue to hold going forward. So we think from a valuation point of view, still very good. You're getting yields of north of 4% on the long end in dollars. But also, we just think, so we think attractive. We think you'll get returns regardless of any kind of crisis. But we also think that it provides a good hedge if there is any unforeseen event. I've got a few minutes quickly. Wanted to talk about the treasuries. I know we're limited for time. Quickly, just talking about equity valuations in the US. Equities valuations are being driven by earnings. So this is definitely not a bubble. The earnings, the difference, everyone's kind of talking about 2001. 2001 was driven by debt. It was not driven by earnings. This is driven by earnings. PEG ratio sitting at 1.38. That's price earnings to growth. Kind of your long run average. So not looking expensive. And then you've got to also look at margins. These businesses today, you can't value them like you would an industrial business 50 years ago. Capital intense, low margin, heavy industrial business. These are extremely high gross margin businesses with very low capital requirements, just basically printing cash. And you can see over time how the quality of companies on the S&P 500 have just improved. So the net income margins in the 90s, this is just per decade. In the 90s was 5.6%. It's doubled. It's doubled in 40 years to 10.3%. At just the S&P 500, it can show you the quality of innovation and just the quality of these businesses. And there's also an argument, a philosophical argument. Well, should you be valuing a business based on how you would value it in the 90s if it's twice as profitable, essentially, or twice as, if the quality of the business is twice as good? Just on that, US has not done as well as some of your global markets this year, but most of the global markets have been driven by re-ratings. So you can see the valuation that valuation is extended. Whereas in the US, it's actually dropped. And I mean, this is just a magnificent seven. I mean, so the whole of the US, you have had a kind of a re-rating on the broader market. But if you look at the magnificent seven, it's actually just been driven by earnings. So, these earnings just keep coming through. I mean, they've had a 15%, 16% growth in earnings, and this was as of August. So it's very important to note. So if you just do a quick calculation, you say, what was the forward PE of the S&P 500 at the high after COVID? It was about 22. What's the forward PE now? And I mean, since COVID, we've had a massive run. We've had we have three double-digit return years in a row. You say, well, what's the PE now? Precisely 22. It has not re-rated from an earnings point of view. That return has been fully driven by earnings. And that's what we're watching closely. You've got to watch these earnings coming out. So still bullish on the markets, but again, managing our risk in terms of, what's our exposure, and then hedging out with those treasuries that we believe could be, if the world works out that, inflation's not coming and that growth, you're going to start seeing growth coming out. We think those treasuries could re-rate in a positive way, and the dollar could re-rate in a positive way quite quickly, quite aggressively. So, we want to be exposed to that. So that's kind of all I have. Just earnings from the last quarter. You're just seeing earnings beats the whole time coming out through the US. We're in a current earnings cycle, same kind of numbers coming through. 80%. I think at the moment in the current earnings cycle, 86% of businesses that have recorded earnings have beaten expectations. Just a phenomenal place you want to be. You have to be in equities in a market like this. And then, just one last thing, just looking at liquidity, also still very supportive of markets. You can see this is retail money market assets, $2.2 trillion worth of retail money market assets. Still a lot of liquidity that's not in the markets right now that we think is still going to drive. We think fundamentals are pushing the markets, but we think the liquidity support is also there on any pullbacks. So I don't expect protracted pullbacks. We don't think you're going to see them. We think you're going to see buying pressure coming in from all this liquidity. So bonds in the portfolio at the moment sitting at north of 8%. That's US long run treasuries. That's the sort of biggest differentiator we would have in our portfolio at the moment. So still liking equities, got about 34% in global equity at the moment. A lot of it exposed to the US, and then our thematics, our growth ideas. We still like your semiconductors, uranium and nuclear energy has been a great holding for us, and then our sort of growth ideas that we have within the portfolio as well. So obviously running short on time, but really just looking at those treasuries is where you're trying to build a hedge and managing our risk by taking profits from here as this market grows up and putting them into the treasuries. So thank you for your time. I have gone a bit over, but yeah, happy to answer any questions later. Thanks, guys.
Well, thank you very much, JP. You should be able to share if you are ready.
Okay, good. Well, first of all, thanks everybody for joining this morning and taking some time out of your day to hear me drone on about fixed income. Maybe a quick word about myself. I've been in fixed income markets for 25 years. I was actually thinking about this yesterday that it's 16 years since the global financial crisis. There's a lot of people who are in the markets who never saw the global financial crisis. Not that I'm predicting that that's going to happen anytime soon again, but a number of years and number of cycles that have been seen helps to shape the view. So I think with all these things, one shouldn't get too carried away in one direction or another. It's important to remain balanced. I think that's what I'm talking about today. After the rallies that we've seen in SA bonds, is it time to be a little bit more tactical and reduce some of the exposure? So we've heard quite a bit about US Treasuries and US rates today this morning already. I'm just going to have a couple of slides because obviously they form the foundation for valuations in South Africa, and we have to think about where global rates are going to be. This chart just shows you the yellow dots are the Fed members, the Fed voting members, and where they expect interest rates to be. And you can see that the dot here in 2025, that's mirroring the latest Trump appointee who expects interest rates to be significantly lower than the rest. There are a couple of interesting things here, I think, in the chart. One is that there's quite a large dispersion in expectations for interest rate policy going forward, and I don't think that's irrational. Although Mirren may be irrational, I don't think the rest of the members are necessarily being irrational, because I think the data, as Paul pointed out, the data isn't coming out at the moment because of the federal shutdown. But the data up until that point has been very mixed. We've seen some weakness in housing, a weakness in unemployment. So it's a mixed picture, and it certainly it doesn't point necessarily to a massive slowdown or a massive growth phase, but rather that there is some uncertainty as to which path we're taking. That, of course, with a large dollop of tariffs, and those tariffs working their way through the system, may also lead to further policy uncertainty. But if you look at the green line here, that's where the Fed members on average think interest rates are going to be, and what's priced in is basically going down to the low threes in fairly short order from where we are today. What's interesting here is also that the white and purple lines are where the market is pricing. You can see the market's price is a little bit more aggressive than the Fed members. This is not an unusual thing. Quite often the market is overly optimistic for cuts or pessimistic for cuts, versus where the Fed members are. And the Fed members themselves tend to be quite slow moving in terms of their outlook, and whereas the market can get a little bit more carried away. But nevertheless, there is quite a lot of rate cuts priced in, and certainly more than the Federal Reserve members themselves are saying they think is likely to come. Obviously, we've also got a period of potential political interference in the White House. We've seen that here with the first dot There's obviously a lot of pressure on the Fed to cut interest rates and to avoid any future recessions. It's quite hard to know how that's going to play out. I mean, you can kind of think of that as, a bit of a game theory in that, the Fed doesn't want to look like it's, not independent, but equally, doesn't want to, just let the economy fall off a cliff if that's going to happen. So there are quite a few, things going on there in terms of the thinking of the Fed, but the bottom line is there's quite a lot is priced in terms of rate cuts. So you can see this in this chart. This just shows you the top line is where the US Treasury curve was at the beginning of the year, and the green line is where we are today. And you can see a lot of that change has really been driven by the sort of 1 to 3 area here that you can see where there's been market, as in the previous chart, is showing expectations of quite a lot of rate cuts. So what does that really mean for South Africa? So we bring that back to SA. Obviously, our monetary policy, does base itself off what's going on in the rest of the world. We are a very small open economy, and we do get buffeted by global economic events and global monetary policy, and it does feed through into how we think about where SA rates are going. And obviously that, we see movements, a lot of that gets translated through the rand, which I'll talk about in a couple of slides time. But if we just look at where the market is right now and where it was 3 months ago, markets, this is the forward rate agreement market, the FRA market, just where the market expects interest rates to go from here. And you can see that there's about 60 basis points of cuts priced in over the next 12 months, which is, I guess, consistent with what we've been seeing from the Reserve Bank, saying that they believe that we're in a lower inflation environment. The rand has been strong, and if we see the kind of interest rates that are priced in to the US market, then there certainly is scope for further rate cuts. But there are 60 basis points worth of cuts, taking us down to the low sixes in repo. That's kind of priced into the market. Obviously, we end up with a much lower inflation picture, as Lesetja Kganyago has been talking about. Then we there is certainly the scope for those cuts, and if the US also produces some cuts, that could be the case. So what's really been driving the rand and the better picture for SA bonds and in our inflation and outlook is the much talked about terms of trade. So the chart on the left here is just our terms of trade, so i.e. the things that we export versus the things that we import, and the kind of rough guide to that is sort of gold versus oil. Obviously export gold, platinum, etc., and then import oil. And you can see that here of late our terms of trade have been improving significantly on the back of what we've seen, a much stronger precious metal prices and a relatively contained oil price. So that's the kind of aggregate rule of thumb number. But if you look on the right hand side, you can actually see the actual exports of precious metals. The grey line is the actual exports of precious metals, which you'd expect to have really taken off given the prices, but we haven't really seen that, and that kind of talks a little bit to kind of the logistical issues that we have in SA of getting these precious metals out of the ground and then getting them on boats to export them. This is one of my favorite charts. This is the oil price in rand, and I think it's a big driver of what's been driving our market. And you can see on the right hand side of that chart that we've seen quite a strong period for that metric. We've had lower oil prices and we've had a stronger rand, and those two have fed through to much lower oil price in rand, and then obviously that is disinflationary and has and in large part led to the kind of the sort of lower inflation environment that we've seen. The question, of course, is how long will this continue, and where do we go from here? I'm not an oil price analyst, but both the oil price and the rand have been pretty strong. So the weight of expectations might be that this increases from here. This chart just talks about where credit spreads are, talks to global risk appetite. The two lines here are the blue is the emerging market CDS, 5-year CDS, so credit default swap curve, just says what you have to pay to insure against the default in EM. And you can see that spreads are at tight levels, and South Africa has very much been moving in lockstep with that, with the grey line being our 5-year CDS, pretty much at tights of recent history. So we need to see some either improved global risk appetite, which in some ways is quite hard to see, or we need to see some really good idiosyncratic South African improvement in our credit rating and credit, and that could happen. But again, we are at tights versus where we've been in recent history. So one has to be a little bit cautious about where we are at these levels. This chart just shows you what's happened since the end of the year, or the beginning of this year, versus where we are today. With the lower line is where we are today. We've seen broad rally across the curve, and largely driven by lower interest rates and lower expectations for interest rates. And while we've got additional interest rate cuts priced into the market, how far do we go with that? And what does that picture look like from here? When we look at multi-asset income funds, we've got a large toolbox of investments that we can invest in, and that allows managers like myself to switch between different asset classes at points in time. So it's when we think about bonds or ILBs or money market, I do have the ability to switch between asset classes when I think they've run hard, and when valuations look a bit stretched, then there is the opportunity to kind of move into other markets and take shelter, and potentially in some other asset classes in the space. And you'll see that both in the Methodical income fund that I run, which is really focused on that STEFI +1 benchmark, and as well as the Methodical dynamic income fund, which is a STEFI +2 benchmark, which is much more of an asset allocation fund, which I'll talk about shortly. This is just showing you where pricing is today. If we look at kind of the benchmark that I mentioned for the income fund, the 1-year cash swap is at +1%. It gets you to about 7.85. So that's kind of what you want to achieve net of fees for the income fund. That looks a bit depressing, I guess, for a lot of investors, versus recent history, where we've been getting kind of 10% returns, 1-year returns. But obviously interest rates have come off, and we've also seen quite a strong move in rand. So I would maybe temper people's or investors' enthusiasm for income returns going forward. But that kind of sets the benchmark. And then look, there's a whole bunch of different assets in here that can be accessed, including on the right-hand side, longer-term government bonds. And we do still have a relatively steep yield curve, so there is a pickup for taking duration risk in the SA market. But as I mentioned, we have come quite a long way, so one needs to be a little bit more cautious about taking that duration risk just where we sit at the moment. Briefly, I don't know where we are with time, but briefly, the client experience, we've got As I mentioned, the income fund, which is looking for some steady, I call it the widows and orphans fund, the sort of steady returns with that STEFI +1 benchmark. It is an asset allocation fund. It can move across all those different types of asset classes and look at the relative pricing of all of those asset classes at what points in time. So there are the opportunity to add returns. In fact, we've done an analysis, and typically the returns have been about 1% above where the current yield is, but due to kind of moving the portfolio around. So there is movement, there is ability to add value through that. And then in the dynamic fund, it's more of a better of bonds, best ideas kind of fund. So it has a greater risk tolerance, but equally we think of that as kind of an asset allocation fund, considering that kind of CPI +4 +5 kind of bucket, which if you think about the risk you're taking in fixed income versus the risk you're getting in other markets, that's still a pretty good return, with limited risk. That's my story.
JP, thank you very much for that. A lot of information there. And while I've got you on, I maybe want to start with 1 or 2 questions with you. Looking specifically at your dynamic income fund, and you've showed the graph, looking at SA credit trading, almost below nominal bonds, especially if you look at some of the banks. So we all know SA credit definitely not as attractive as what it was a year and a half ago. Some risks in govies as well, so you can't go full out exactly the point you made on longer dated bonds. But how do you then position to still give clients that CPI +4 to 5 type of returns? We've been spoiled with bonds. We've heard a couple of managers still very bullish on nominals, especially in a cutting cycle. You've made the point, there are some risks, but how do you position then to still give clients a fairly decent return and to make their target?
Yeah, so I mean, there's a couple of things there. One is that I think of the dynamic fund as more of kind of an absolute return fund. So it's looking at kind of those, let's say 10% kind of returns over time. So if you think about inflation being somewhere around, I know the Reserve Bank thinks it's going to be 3. We'll see, but if we kind of think about inflation being 4.5, if you're getting 4 or 5 above inflation, then you're getting close to 10% on a kind of a long-term target. There are places to hide. I mean, obviously, inflation-linked bonds themselves give you, inflation +4, inflation +5, as it stands at the moment. That's obviously been quite a disappointing place relative to the nominals because inflation is being contained. But if one has a kind of a cool head about this, then one realizes that it doesn't necessarily always go in one direction. If everybody kind of believes one thing, it's probably time not to believe that. So there are places to hide. I still have exposure in that fund to the nominal bond curve, but what I am doing is trimming as we've seen these strong rallies. Over time, the SA bond market has produced volatility. And I want to be able to, and I want to have some powder dry to actually take advantage of volatility. I'm not predicting where it comes from, but all I know is that when you do have markets that are priced, I hate to use the word perfection, but when they're priced quite tightly, then there's always the scope for anything, to kind of rock that view of markets.
So a lot of risk mitigation in the fund as well. I want to go back to almost, the starting point of your presentation and looking at the Fed dot plot. And if you look at some of the members, and their target rates going into 2026, I mean, further out is unclear. But there's still a couple of members in the Fed where they're setting the target rate higher than current levels, so all not convinced that inflation is potentially under control. Is that the message that we're getting there?
Yeah, I mean, I think as I said, I think the message is that there's a lot of uncertainty, and a lot of caution. Look, I mean, central bankers are kind of inflation obsessed. That's their nature, and they worry about inflation. They wake up at 2 a.m. Worrying about inflation, and so to expect, you kind of expect them to kind of worry about the pass through from the tariffs, as an example, and a weak dollar. We've seen it, as Paul mentioned, a weak dollar. So all of those things potentially could be inflationary. And obviously, there is also some uncertainty as to, how that transmission mechanism of the tariffs will work. We've seen it in South Africa as an example. When we see real large bouts of weakness in the rand, we don't necessarily see that inflation coming through in the next month or 2 months or 3 months. But and typically the importers kind of absorb some of that weakness in the first few months, but then eventually they've got hedges in place, etc. But then eventually the dam wall breaks, and then you see the inflation coming through. And I think that's perhaps a bit of a concern with some of the Fed members, that if these tariffs, that these tariffs might take a bit of time to feed through. I'm not saying it's going to be the case, but it's certainly where we are, and what they concern themselves. But as I say, Fed members are kind of obsessed with inflation, with the inflation picture.
Definitely that. And Paul, if we could maybe continue with this discussion, because you had a lot of information specifically on US inflation. And I've seen some interesting data when you look at US inflation and not just the Fed dot plot. And speaking to things like tariff, exactly what JP alluded to now, the data shows that a lot of the implied tariffs, or some of the tariffs existing already, are being absorbed by corporates currently, and not yet the end user. But it seems that the end user, or the consumer, especially in the US, are going to start paying for this in 2026, and that could be inflationary by nature. Your view on that?
Yeah, we differ slightly. If you look at so that would imply that the company's margins are dropping, and that earnings would be dropping, and you're not seeing that in the results. So if you're looking at, we actually currently in an earnings cycle right now. The S&P 500 is going through announcements right now, and as I said, 86% of companies are actually reporting increased earnings, not reduced earnings, and those margins are maintaining. So what's actually happening is, yes, you're right, and this is what we actually thought would happen, is the companies are taking on a lot of that tariff cost, but they're saving elsewhere due to efficiencies. For example, exposure to things like AI and places like that. As JP mentioned, the oil price is down. It's not a coincidence that the oil price is down right now. You're having this supply side growth impulse coming through that market that's going to create opportunity for other forms of energy. One of the reasons we own nuclear and uranium is because you're getting a massive amount of plants coming online. So to try and look at it, that's the problem. To try and look at it as, saying, okay, well, tariffs are going to have an input cost, and that's, you're looking at kind of a one input, and then trying to predict what happens. There are many affected things that come in with that. So what's happening is, yes, the companies are taking on the tariff, which we believe was always going to be the case, but they're getting savings elsewhere in their supply chain. And that's what you're seeing. And the numbers are kind of, we could debate this, but the numbers are showing that when the earnings are coming out, you're not seeing reduced earnings on these businesses. You're seeing, they're actually beating expectations. So that's the things you've got to look at and realize that it's not that simple. It's not as simple as saying, well, if one cost goes up, you can't do a multivariate analysis like that. Yes, one cost can go up and another can come down. And you got to kind of look and break through the whole inflation quantum to kind of see what's going to happen. So that would be my short answer.
Your use of US Treasury is very interesting, and that's a position you've held now for some time as a part hedge, and I think the audience also finds it very interesting, because we're all suffering from gold FOMO. We didn't have enough gold, but we also realize that the price is extremely high at the moment. Yeah, can gold go to 5,000 or 6,000? I don't know. Nobody knows. Nobody can really tell you, but we know it's very high, so it might be a very good alternative. However, if you look at US bonds, from a SA investor perspective, when you buy US bonds, yes, the yields are attractive, but we know the dollar is under pressure. Your view is slightly different, that you think the dollar might improve. But are we not in a, a cycle where the dollar could structurally remain under pressure, especially if the Fed continues to cut in 2026, and then investing in US bonds, being an SA investor, could that not detract from my rand-based outcome?
Yeah, so I mean, how we look at it is we look at it at the portfolio construction level. So we're not trying to predict. You can't time when that dollar is going to turn. That's a
Yeah,
cyclical move. Anyone who's listened to me before, we don't try and predict cycles. We don't know when the cycles will change. We do like to predict secular sort of long run trends, but the cycles are virtually impossible to predict. So we don't have a view on when the dollar will start to improve. But what we do think is if you see the status quo, so what's been happening up till now, we're going to get exposure to that in the offshore equities anyway. So I mean, you've had a debasing dollar for the last year and a half, debasing treasuries for the last year and a half. But you've seen the S&P 500 just continue to do double-digit returns, and it's supported by earnings. So we've got exposure to that part of the market. What we're saying is, if you do see a change, so it's not about trying to predict when, but it's saying if you do see a change and you start to see a recovery there, number one, it's providing just if there's an external shock somewhere. I don't know. I mean, anything could hit us at any point in time, and you see a massive sell-off like a panic sell-off in shares or anything that's perceived to be, let's call it in bubble territory that's run really hard, we think that those treasuries would provide good protection on an external just shock, number one. And number two is we just think that at some point it will turn. And because we're getting such good returns in our equity exposures, it's giving us a good opportunity here. It's almost, think of it like, it's almost like a derivative of like a barbell strategy in an income portfolio. You can
yeah,
have your longer run, long duration assets, which in this case would be your equities, hedged by kind of something that's got either lower volatility or in this case actually negative correlations to a market shock. So we think that that's why. So you got to look at it in the context of the whole portfolio. So we've owned bonds. I mean, just to give you an example, I mean our annualized return on that fund is beating benchmark by 4% a year in spite of our bonds. We've owned bonds for the last year and a half. In spite of owning
yeah.
them, we have beaten the benchmark by 4% a year. So it's looking at the whole portfolio. So we actually think it's a great place to be because we're not forced to take on excess risk if we don't want to. We can hedge it, and we're quite happy that we can sleep at night and still benefit from high returns in the market. Again, yeah, you're right. I mean, gold could go to $5,000-$6,000 quite easily. We're not going to try and predict that cycle. Yeah.
I think I share your views. I'm not in that boat. Um, and you made the point. I mean, it's exactly that, and that's what clients can expect or investors expect in your fund. It's about the overall portfolio construct, looking at all the moving parts relative to each other as well, and how do you balance out the risk. Just to test your views quickly on emerging markets, because there's renewed interest in emerging markets in portfolios, especially now with the dollar under pressure. And it could speak again to a cycle where more cyclical type of stocks can benefit. Is that something that you're starting to pull into the portfolios on the global equity cargo?
Yeah, so I mean, if you look at emerging markets this year, been quite good performance. It's really been a re-rating. It hasn't been driven by underpinning earnings at all. The valuations have extended. Not to say that they're expensive now. They were quite cheap, and that increase in prices has been a valuation re-rating. It depends on which emerging market. We're not too positive on China at the moment. We think that China's got some serious economic headwinds ahead of it. You can almost see there's a little bit of they actually got their fourth plenum right now. They're meeting now. It's their fourth meeting of this 5-year plan, and the
Yeah.
third year of the latest 5-year plan. And just looking kind of behind the scenes, there's some political, I don't think Xi's power situation is as robust as he would like. And I think there's a lot going on there. So I think he's going to be spending a lot of time watching his back at the moment and thinking too much about long-term economic policy. And you can see it. I mean, the announcement on the rare earths, these trade restrictions or these export curbs on the rare earths. We think that's a panic move more than anything, reading between the lines. He's trying to create a narrative around that because he's worried about his own power grab. So, China, we're not that bullish on. We do have a little bit of emerging market exposure in the fund. It's about 2%. It's not very high. The others, for us, it's a relative to what scenario. We
Yeah.
really like the US at the moment. We've been banging on this drum for a while now. It's not just the US economy, it's the fact that all equities, I mean, any innovative equity that's breaking new ground, that's shifting paradigms is a US listed stock. It's not that we trying to avoid other parts of the world. It's just, you can't buy Nvidia in Germany. You have to buy it in the US. And so we like the economy. We think that there's big growth drivers there, but really that US market is it relies on a global economic story, not just a US economic story. And it's just the part of the market that we think has the most innovation, and that's going to be best set up for what we see going forward in the world. So it's not that other than China, it's not that we negative emerging markets. We just don't see relative to what we can buy in the US now, sort of risk adjusted potential there.
It also speaks to themes finding their way into your portfolio. I mean, you've mentioned a couple of examples of that as well, and you've illustrated that very clearly. JP, maybe just back to your question from the audience. I know the yield from Rand Hedge high yield bonds. Are you invested in this asset class, and if so, are you concerned about high yield spreads?
I'm not, because I tend to like the liquidity of that asset allocation process. As I mentioned, being able to shift between different asset classes, and high yield isn't always the most liquid. But I think spreads are pretty tight. Looking from afar, I look at them just to get a sense of where we are from a macro perspective. And yields are pretty tight relative to where they've been historically, and it kind of talks to maybe somewhat easier monetary conditions. But I don't have any in the portfolio.
JP, one last question from a portfolio construction point of view. We've seen SA property creeping back very small numbers into some income funds that used to be used broadly 5-6 years ago. SA property improving, and some income fund managers might say, it's too volatile for the kind of mandate. Is this something you would look again in income funds? I know mandates allow for it, but does that sit in your scope?
Yeah, look, they are volatile. I mean, you've got to think about what you expect. They tend to be kind of a leveraged version of bonds. So can you get that exposure from much cleaner exposure from without kind of having to think about management and think about the idiosyncratic risks attached to property and rates and all of the other things that are involved in property. You can get a lot of that from the bond market if you're bullish about long-term rates. So it's got quite a high hurdle rate for the funds. It has to really be kind of outstanding value to be included, because as we talk about this, they are quite volatile.
Gentlemen, the clock caught up with us. I'm going to pause it there. There's no open questions from the audience anymore. Thank you so much for your time this morning. Your views very interesting, and I think a lot to think about there from what we've heard over the past few weeks as well. Paul, JP, thank you so much for your time this morning. Both your funds proved to be very consistent over time. Paul, here, shorter term history. But since inception, I mean, your fund stood its ground, and it speaks to your asset allocation and looking for those opportunities for clients. JP as well, thank you for your insights this morning and views on bonds and how it all comes together in your income solutions. Thank you very much. Greatly appreciate it.
Thanks, Eugene. Thanks,
Eugene.
everyone else. Thanks, JP.
Thank you.
Cheers, guys.
To our audience, thank you very much for joining us this morning. Just a quick reminder, remember, tomorrow we've got another hedge fund webinar where we continue our discussions on hedge funds. And then next week, Wednesday, we've got a panel discussion on SA equity, and that will be interesting as well. Thank you so much for your time this morning, and have a super week further. Thank you.